If you've been an avid listener, we have mentioned the perfect storm in real estate twice or more. But is there such a thing as a perfect storm? The impact of this perfect storm is not limited to commercial real estate, as it may also affect the housing market and the broader financial system. Some experts have warned about the potential challenges and disruptions that could arise in the real estate sector, particularly in the commercial real estate market, as a result of this perfect storm. Don't click away. Nova Society is about to reveal the keys to financial success. Stay with us and unlock your potential. If we could get 400 likes on this video, that would be insane, because we love making these videos for you. The real estate market right now has some tough hurdles like higher interest rates, inflation, and not enough houses for sale. Some experts are saying this mix could mean trouble ahead for real estate. Barry Sternlicht and others think prices might drop, and there could be more foreclosed homes in the near future. The real estate market. Sternlicht does more than just real estate. He's good at investing in buildings. Right now, people think the housing market might have some problems because interest rates are going up.
Higher.
That makes it harder for folks to pay back loans on time, and there's worry more people might not be able to pay back what they owe. Sternlicht has some interesting thoughts about this.
Anything with a fixed income stream is worth less when rates rise. And the underlying fundamentals in most of the asset classes in real estate are okay right now in the United States. The apartment market, the industrial logistics market, the hotel markets, those are all in good shape. But there's no question that the Fed has reacted dramatically to try to slow the economy down quite late, obviously. And that has impacted real estate values. Yields on properties are moving up to reflect this higher interest rate. And the supply of credit to the industry is curtailed dramatically. So I like to say it's a hurricane over real estate right now. We're in the Category 5 hurricane, and it's sort of a black cloud hovering over the entire industry until we get some relief or some understanding of what the Fed's going to do over the longer term.
Real estate values and interest rates. Understanding how real estate values connect to interest rates is crucial. Real estate is like having something that gives you money regularly, kind of like getting paid every year. Imagine having an office building that someone rents for 10 years. You know you'll get money from that rent every year. That money you expect is the fixed income from real estate. Barry Sternlicht talked about how when interest rates go up, things like real estate that give you fixed money start to lose value.
No! God, please, no! No! No!
To explain, let's think about owning a small apartment building. Think about having a building that makes $100,000 each year. That's the money left after paying for stuff like fixing things, taxes, management, and finding tenants. Say this money grows by 5% each year. You're thinking of selling the building in 5 years. In real estate, they use something called the capitalization rate to figure out how much a property is worth if you bought it all with cash, based on what it makes in a year. Here's how you find the building's value in 5 years. Take the money it makes or net operating income and divide it by the cap rate. That gives you its worth. But to figure out what it's worth right now, you've got to adjust the money it'll make in the next 5 years to account for how money changes over time. This is called the time value of money. Using a 6% interest rate, the building is worth about $2.28 million right now. If interest rates go up, the property isn't worth as much. Let's say the interest rate jumps from 6% to 7%. Suddenly, the building's value drops to about $2.18 million, down $100,000. Why? Well, higher rates mean the future money it'll make isn't worth as much now. Plus, when rates go up, the property's selling price goes down. If the cap rate goes from 5% to 6%, that lowers the future selling price even more. So, if rates rise, the property's worth today might tumble from $2.18 million to $1.89 million. This shows how big an impact interest rates can have on property values. Even if the money it makes stays the same, higher rates can make a property worth a lot less. Right now, things are looking good in real estate, but Sternlicht thinks that might change soon. Recession.
So in this example, the annual cash the apartment building generates increases by 5% each year as rents rise. At the end of the 5 years, you will then sell the apartment building and pocket the money from the sale. In commercial real estate, the value of a property is determined by what is called a cap rate.
Supply and demand. Sure, real estate is like any other thing you buy or sell. Think of it like something you might buy at a store. The price depends on how much there is and how much people want it. Let's talk about those apartments again. Remember, their value comes from the money they make. But how much can owners charge for rent? It's all about how many apartments are up for rent and how many people want to rent them. Imagine a graph. One side shows how many apartments are available, that's the supply, and the other side shows how many people want to rent them, that's the demand. Where these lines cross on the graph is the price. Here, it's how much rent owners can charge for the apartments. When things are going well and there's a lot of need but not enough stuff, that's a good sign.
That's good. That's good, right?
Lately, the economy has been doing well. Not many people are without jobs, and the government is giving a lot of money to help. Also, houses have become so expensive that lots of folks can't buy them, so they're renting apartments more. Because more people want apartments, the price of rent goes up. When rent goes up, apartment buildings make more money, which makes them worth more. But things can quickly go downhill. When there's a recession, fewer people might want apartments because they've lost jobs or need to save money by living with family or sharing places with roommates. Some folks who already live in apartments might have trouble paying rent and might have to leave. That's not good for the building owners. It costs them more and they make less money. When the economy isn't doing well, fewer people want apartments, so the demand for them drops. Moreover, when the economy is doing well, there's a tendency to build more apartment buildings. However, it takes a while, usually between 1 to 2 years, from planning to renting out these apartments. That's what's happening now, with about 560,000 new apartments hitting the market in 2023, the most in 20 years. Most of these projects started in 2021 and 2022 when the economy looked good. All these new places for rent mean there's more supply than before, which makes the rent prices go down where the lines for supply and demand meet. Sternlicht also focuses on 2 other types of property: office buildings and how the increase in working from home might change the office market. Remote work.
So nice buildings, even in a city as currently destitute as San Francisco from an office market perspective, the best buildings are still leased. And so you're going to see a bifurcation of the market in office. The nice buildings will stay rented, and my guess is at pretty good rates. And the B and C stuff is going to be maybe fields of grain or something. It'll be very pretty. We'll have all these little mid-block parks in New York City because there won't be anything else to do with those buildings. And nobody will carry them because there's no hope.
Most office workers these days don't want to spend all their work time in a regular office. This change in how people work is seriously affecting the office property market because companies don't need as much office space as before.
I don't take up much space.
It's gotten so tough that many office buildings, which used to be full of workers, might end up empty and maybe even torn down. For example, in San Francisco, nearly 30% of office spaces are vacant, which means about 30% of all offices there don't have anyone working in them. But not all office buildings are facing this problem the same way. Offices get split into 3 groups, called A, B, and C. A class is the fanciest, and C class is the least fancy. The top-quality A-class offices are still in demand because some companies want their employees back in nice offices. But the ones in the C-class aren't doing so well. These buildings are usually older and in not-so-great areas. Things look so bad for these C-class buildings that sometimes it's cheaper for the owners to tear them down instead of paying to keep them up when no one's using them. Another part of real estate causing worry is single-family houses. Barry Sternlicht's company Starwood owns more than 3,200 single-family houses all over the country, and he's keeping a close eye on what's happening in the housing market. Housing.
I think the housing market's had a very unusual situation where Powell's increase in rates has diminished supply. And people, I'm not sure we've ever had a situation where so many people have locked in their mortgage costs. So right now, people are sticking in their house, which has diminished the supply of homes for sale.
Home prices in the United States have dropped to almost the lowest they've been in a long time. The chart from Goldman Sachs shows this housing affordability index, which covers more than 25 years. When the index number is low, it means it's harder for the average person to buy a home. This has got a lot of people worried that the US housing market might be in a bubble. There are two main reasons why homes have become less affordable. The first one is pretty clear. Home prices all across the country have shot up by a lot. In June of this year, the average selling price for a home in the US hit a high of $416,000. Just 3 years ago, in June 2018, it was $315,000. But that's only part of the problem. The other big thing making it tough for regular folks to buy homes is that interest rates have gone up lately. At the start of 2021, the typical interest rate for a regular 30-year home loan was about 2.65%. But now, it's shot up to as high as 7%. This big increase in interest rates has made buying a home with a mortgage a lot more expensive. Let's imagine this situation. Say you have a $400,000 loan for 30 years, and with a 2% interest rate, you're paying around $1,478 per month. But if we keep everything else the same and bump up the interest rate to 7%, suddenly the monthly payment jumps to $2,661. That's an 80% increase in what you pay each month, even though the loan amount hasn't changed at all. Usually, you'd think that higher interest rates would make home prices go down, but that's not what's happening. People who bought homes when interest rates were low now feel stuck. They're afraid to sell because doing so means they'll lose out on those low interest rates. This means fewer houses are up for sale, and because of that, the prices keep going up. In short, the future of the real estate market is unclear, and we'll have to wait and see what happens. Sternlicht expects a tough time for many folks in the next year or so, but he's also hinted at a possible upside, mentioning the phrase, "survive till 2025. This suggests that those who can hang in there until 2025 might find good chances ahead. It's important to remember that the real estate market is sensitive, and many things can influence how it does in the future. We can't know for sure if there's a tough road ahead for real estate. Whether or not people can be happy about a perfect storm in the real estate market depends on their circumstances. For some people, a perfect storm in the real estate market may be a great opportunity to buy a home at a lower price. For others, it may be a time of great anxiety and uncertainty. Ultimately, the decision of whether or not to buy or sell a home in a perfect storm market is a personal one. Unlock the secrets of personal finance and generational wealth mastery on our channel. Subscribe for empowering videos that elevate your wealth, and be sure to support us by giving this video a thumbs up to help our channel grow. Please click on the next video for more financial wealth building strategies.